morning, everyone. My name is Mike Mondelli. I'm a senior manager with Eide Bailey, and I'm part of our firm's Tax Controversy and Procedure Group, which is part of our National Tax Office. Joining me today is Elise Katz, who is a CPA and a manager in our firm's Scottsdale office. She recently joined us as a former IRS revenue agent, and she's been with the team for about 6 weeks. So we're excited to have her on board and share some of her experience with us on today's webinar. Our team, as I mentioned, is part of the National Tax Office here at Eide Bailey, which is a diverse group of subject matter experts in a lot of tax areas, including our group, Tax Controversy and Procedure. Also, we have experts in international tax, state and local tax, tax-exempt organizations, pass-throughs such as partnerships and S corporations, accounting methods, fixed asset services and cost segregation, R&D tax credits, and a few other ones, including Affordable Care Act compliance and others. So we have a lot of help here at Eide Bailey for whatever issues come up. Some of the things that we're going to discuss today include some of the current audit issues that we see being raised by the IRS a lot, some new items that they're focusing in on, and some that are just perpetually in their focus area. We're going to discuss how to get through an examination and how we like to protect our clients from penalties and other adjustments. We'll also discuss how to get to IRS appeals, including settling with IRS Office of Chief Counsel Attorneys. Then we'll discuss some fresh items, including the new partnership audit rules that are now in effect, and some tax reform topics and what they can mean to you. So on our team, we've got, in addition to myself and Elise, we have Ben Peeler. He's the director of our tax controversy practice. He's a former IRS Chief Counsel Attorney. We also have a number of CPAs, IRS enrolled agents, and some others helping us out. We have about 10 people on our team now. So I'm going to go ahead and turn it over to Elise to discuss some statistics in IRS audit activity. And one thing to note, today's webinar was originally going to cover some IRS collections issues. We had to redo the topics because of some conflicts with our presenters in the collection space. So we're going to be rescheduling that one for another date if you're looking for that content.
All right, thanks, Mike. Good morning. I'm not sure if he mentioned, but yeah, I was an IRS revenue agent for 9 years in the small business self-employed. So I do have a bit of experience with going through IRS examinations. So IRS activity in the last couple of years, you can see that it's actually gone down, and that's probably attributed to the IRS force is actually shrinking. They haven't hired in about 5 to 7 years. They're starting to hire more now that Congress has set a budget. So you may see an uptick in that as they're hiring more, but overall, individual returns get the most traction for IRS exams. And then you have C Corps, S Corps, correspondence audits that are handled just through the service center, where they basically just send you a letter and they want you to mail in some documentation, maybe something doesn't match up, or you have a full-blown audit with a field agent. And that is the largest percentage of the audits that you're going to have. Partnerships, they were audited the least. That may increase going forward as well. I have seen the IRS's focus change a little bit in the past couple of years to be focused on that. I think one thing too with the individual returns, why that's so high, is because the IRS likes to do what they call package audits. So even though they may start with your S corporation or even your C Corp or your partnership, that they are always going to expand into the individual returns who own that corporation, because they like to consider package audits. So like I said, you may see an uptick going forward with the hiring that's coming, but the overall chances that you are getting audited is low, as you can see.
It's kind of interesting how the percentages have dropped. I think when I joined the IRS in 2009, the
Yeah.
overall audit rate was about 1%. And just due to attrition and not being able to backfill some of those positions, it's really dropped quite a bit.
Yep, definitely. The number of employees has gone down because they can't do those backfills. So, all right, that brings us to our first polling question. What percentage of returns were examined in the IRS fiscal year 2017?
So Elise, you said that you were a revenue agent for about 9 years at the IRS. Were you down in the Phoenix area that whole time?
Yep, I was in the Phoenix office up on Central and Indian School the whole time. So yeah, I've gotten to know a lot of the people up there, and definitely was a good experience. But being in the private sector has been very enjoyable so far.
Yes, I always joke that when I joined Eide Bailey from the IRS, it didn't take me long from saying, how can these taxpayers be doing this, to turning around and saying, how can they do this to our clients?
Exactly. It's the dark side, depending on who you ask. So.
Right. So I was in the St. Paul, Minnesota office. I worked in exam for about 4 years, and then I was with the Office of Chief Counsel for another 2.5 years or so. And Ben Peeler, our director, was with the IRS for about 8 years. So we've got some pretty decent IRS experience. And the answer to this question was D, 0.5%. Was the percentage examined in 2017. Again, you don't need to have the correct answer to get your CPE credit, you just need to answer each question.
And it looks like most of you got that right anyways, so moving on. So let's talk about the tax gap. So the tax gap is the difference between the total amounts of taxes owed to the government versus the amount they actually receive. It's generally caused by taxpayers, overstating deductions, understating their income so they can pay fewer taxes, but also late paying, or the IRS not being able to collect on the tax also increases that tax gap. Now, this is information from 2008 through 2010. They haven't provided additional data since 2010. They're claiming that it hasn't changed. I'm not sure if that's true, but this is the data that we have essentially, with individuals being the highest at in 264 billion, corporations 41 billion, and employment tax 81 billion. So you can see they're really trying to close that tax gap. I don't know if it'll ever happen, but that's the goal.
So some of the areas that we're going to talk about in terms of current audit issues in IRS examinations, and we'll expand on some of these, including captive insurance or micro captives under 831B, conservation easements, and R&D credits. But there's this idea of under LB&I, or large business and international, the IRS has developed what they're calling campaigns, and there's about 40 to 50 of these campaigns ongoing right now. What the IRS has said is that these are not replacing audits. It's just another tool in their toolbox for audit selection, or how they find the tax returns or issues that they want to audit. So some of these are being addressed in what they're calling soft letters, meaning they send a letter out to the taxpayer saying, maybe you have an issue here, take a look at it, but no affirmative steps required. Whether or not that's leading to an actual audit is sort of uncertain at this point. Things like Section 48C energy credits, related party transactions, some completed contract methods for land developers. Another one that seems to be getting a lot of traction is S corporation losses claimed in excess of basis. So we think we're going to be seeing a lot of that issue examined over the next few years. So we've seen some audit activity driven apparently by some of these campaigns. The IRS doesn't really come out and tell us what generated the audit or caused it, but we do see these campaign issues coming up more and more. We have seen some audits on the international tax area, and We have a different team here at Eide Bailey that covers those issues, led by Shannon Lamont, a partner in Colorado. So if you have any transfer pricing, offshore voluntary disclosure, 5471, 5472 filing requirement issues or penalties, we work hand in hand with our international team on those areas.
Yep. And going off of what Mike had said, basically there's two ways that your return is going to get selected for examination. You have a regular diff score classification, which essentially your numbers on the tax return are compared against norms in a statistical model. And if it's out of the normal range with red flags, it's going to be selected for exam. So that's, you know, just a normal selection, not under one of these campaigns. And then you have the other way, which is the campaign, which this, you know, they're focusing on specific issues, including the research credits. We have that, some of the other things that Mike already touched on. And then you have two different areas for examination. You have the high net worth individuals. Those are people with 10 million assets and above, and that's going to be handled in LB&I. And then anyone below that is handled in SBSC, which is small business self-employed, which they both have different procedures on how they conduct the examination, but overall they're very similar. Other things that they look at: charitable donations, estate and gift tax issues. One thing that they're always going to be looking at, my next slide, is income. So anytime you have an exam, they're always going to look at gross receipts, rents. They're always going to look at income first. And if you have large losses, NOLs, they will definitely be looking into that as well. And they can go back for those NOLs and, you know, request information when they're generated. And also, like Mike said, basis. Basis is one thing that is really easy for them to disprove, and it's just an easy target to go after. So basis in your S corporation or your partnership is going to be one of the first things they address as well, including they also look at S corp reasonable salaries, shareholder loans, business returns. The examiners like to use the balance sheet audit approach, so they'll look at that first, and they can easily see some issues that the return might have that can be abused, shareholder loans back and forth, things such as that. And then R&D credits. One of the things we're seeing a lot right now is this campaign for R&D credits. LB&I has its own campaign that they're doing, and then SBSE is also tacking on to that as well, and we're just seeing a big uptick in that. A couple of states are more aggressively going after the claims. We see a lot coming out of Utah right now, especially from our team for the state of Utah. And you know, going back, LB&I, they are educated on the R&D exam side. They have a lot of information, you know, that they use to audit the financial statements and things like that. And they also use statistical sampling to analyze the business components. SBSE, they're a lot newer to the R&D exam, so you may have just a brand new agent who's never seen the issue before, and it can be frustrating because a lot of times you'll have to educate them on the credit because they're not sure, and they're just kind of following, you know, a white paper in their case file and requesting information that they might have not seen before. So if you do have an R&D exam, it can tend to take a long time. They will request lengthy IDRs, and it can be a long, arduous process.
A lot of those IDRs we're seem to be the same ones over and over, just copied and pasted from either a sample that the agents are provided, or they're just reusing it from a prior exam. So it doesn't seem to really tell us at the outset whether or not the agent has much experience with the R&D credit. If they're just copying and pasting the prior IDR, I tend to think that it's something that they're not as familiar with, rather than digging into the return itself and looking at more specifics about the taxpayer.
Yep, exactly. And you'll learn soon enough within the exam whether they have knowledge or not. But regarding the credit documentation, there's no specific record keeping requirement for these R&D credits. So that's why it can kind of get complicated to respond to these IDRs. But essentially, the taxpayers should gather and retain contemporaneous records for the four-part definition of qualified research, expenses incurred, whether it be the R&D credit or not. You'll want to have your clients keep these sort of records, definitely for expenses. And then they're trying to see a nexus between the qualified activities and the qualified costs. They're looking for substantiation on the qualification criteria, like I said, for that four-part test, which is the permitted purpose, the process of experimentation, eliminating uncertainty, and technological in nature. Like I said, the IDRs can be very long. They're heavily focused on this qualified research activities and expenses section. A lot of times they'll start with an examination on the original return, from what I found, that's claiming this flow-through credit. And then, you'll need to evaluate the information that they're requesting, because they could be requesting information from the business entity that's not even under exam, but they want a significant amount of detail for this credit that's just basically flowing through to the individual return. So sometimes you can push back on the scope of what they're asking and basically say, hey, this is just an individual. They're getting a K-1, or they're getting this information from this other entity, and what you're asking for is out of the scope of the exam. So you want to be diligent on looking at what they're actually asking for and seeing if it even corresponds to your client who's under audit. Another area that I'll go into a little bit more detail about is reasonable compensation. In my experience as a revenue agent, it can be a pain to actually make this adjustment without the cooperation. So yeah, essentially there's numerous ways that people can try and avoid that employment tax. But if you do work with the agent, then hopefully you can come to a reasonable conclusion between the both of you. So on to captive insurance. So I'm sure you've heard of the captive insurance programs before. If not, the IRS has been heavily investigating into these micro captives, mainly the promoters who are selling the idea as a tax, avoidance plan. If you have a micro captive and you get audited, expect it to be an extremely lengthy process as well, similar to the R&D credits. Essentially, everything out of Phoenix was governed by COUNSEL, so the actual revenue agent didn't have that much control over the examination. There's going to be formal recorded interviews. There's going to be multiple lengthy IDRs. They're going to try and gather emails to prove the intent of the formation of the captive, to see if you're forming it for actual risk or if you're forming it for tax purposes. So settlement guidelines, it's not formalized. In Phoenix, they were allowing a reduction in the penalty to the 20% accuracy if you agreed, instead of the 40% substantial understatement attributed to reportable transactions. So, I mean, you know, you have to determine if it's in your best interest to take your case to tax court or appeals or whatnot, or if you think, you know, the time that it will take to just go through the process isn't going to be worth it, you might just try and get that 20% penalty moving forward. The Aberhami case, that was the big case that the IRS considered a win. So that's really the only one right now that I've seen. Have you seen any cases come forward, Mike, besides the Aberhami that really they've been going off on?
Yeah, there have been a couple. There was one recently, Syzygy Inc., I believe, and another one where the tax court basically said it's not insurance, so no deduction, but also it's going to be income as well. So that with a very thinly developed explanation or analysis in these couple of court opinions, they've sort of hit the taxpayer with double taxation. That's not a position that the IRS had previously taken in any settlement negotiations. Hopefully those cases are going to go up on appeal, and we'll see what happens, because that would be a bad result for all the taxpayers who have currently pending appeals on this issue.
Right, exactly. Okay, good. So that comes to our next polling question.
So this is, when is Form 8886 due for captive insurance companies? That would be the disclosure form that's required under the IRS notice that started a few years ago. So your options are A, March 15th or April 17th, 2019, B, May 1st, 2019, C, when the return is filed, if on extension, or D, A or C. So we actually have prepared a lot of disclosure forms on Form 8886 for our clients over the past few years. They have to be attached onto the return, and if it's the first year that the taxpayer is filing the disclosure, then a duplicate copy also has to be sent to the IRS Office of Tax Shelter Analysis, OTSA, which we also take care of as well. So the correct answer here is D, it's A or C. If the return is timely filed by the due date, then a copy of the 8886 should be attached on there. If the return is on extension, then the 8886 is not due by the March or April due date, it's just due by the extended due date or when the return is filed. So originally, when the first captive insurance disclosure forms were filed, they were due by May 1st, 2017. Now they're just due when the tax return is filed. So we're going to move on to conservation easements. So there's two types of conservation easements that the IRS is interested in. There's the syndicated conservation easements and non-syndicated conservation easements. So typically what happens is that the IRS is either going to challenge these based on some valuation issues, or that some technical issue occurred, and so the IRS says you did not dot all the I's and cross all the T's correctly, so therefore we're going to disallow the deduction. Maybe if the Form 8283 is not properly signed by all the required parties, maybe a copy of the valuation report is not attached onto the tax return when it's filed. If there's any sort of those technical hiccups, the IRS will try to disallow the deduction. They don't seem to be too interested in curing technical defects by the taxpayer. In some cases, we are allowed to use substantial compliance and reasonable cause arguments under some circumstances. So we do that whenever we can. The syndicated conservation easements, those are typically challenged as being overvalued. They seem to be funneling some of these issues directly to the Denver, Colorado Office of Chief Counsel Attorneys, who seem to be working a lot of these cases, and they're being directed by the IRS National Office on how to resolve them, not necessarily by settling them, but either forcing the taxpayer to trial or filing a motion for summary judgment based on some technical error. when it comes to making a plan for how to deal with an IRS audit, the way we view this here on our team is that the whole audit is centered around building a file. And we literally mean a file that the IRS has, a paper file, whether that's in a manila envelope or takes up several boxes or maybe fills an entire room with the documentation that the IRS collects as part of the audit. That is referred to as the administrative file in the IRS, and it will travel from IRS office to IRS office depending on who's assigned to the case. So the IRS revenue agent who's working the case in the field collects a lot of documentation, puts it in the file along with their write-ups and lead sheets. If the case goes on to IRS appeals, that whole admin file will be boxed up and shipped off to wherever that appeals officer's office is. If it goes on from appeals to the Office of Chief Counsel to an IRS attorney, again, that whole admin file will be boxed up and mailed off to the IRS attorney's office. So we want to make sure that we get all of our information in the admin file that we're going to need to get the case through appeals, even if it's something that we don't think is going to convince the revenue agent in exam or not, we still want to get it in there. So for example, here, when we're dealing with a captive insurance case, if we think that there's some information that we want to get into the file, whether it's through a narrative or contemporaneous documentation that the taxpayer retained, even if we think we're not going to convince the revenue agent, we still want to get all that documentation in the file. So that way, when it goes on to appeals, it's already in there, we've already provided it, helps us strengthen our argument that, look, the agent should have treated this differently based on what we provided.
Yep, and I think the IRS's goal is to one day go paperless, but I don't foresee that happening anytime soon.
They do paperless audits for National Research Project or NRP exams, isn't that right, Elise?
Not really. Like they still
No?
have the whole paper file that you'll have to print out, but they do collect more information electronically, but the agent still has to download the electronic information and they'll still print it. So it's kind of pointless, but.
Yeah, the IRS is not fast moving when it comes to technological changes. They're still pretty reliant on fax machines. They have finally implemented a lot of e-faxing, but they're at least 10 years behind, I'd say, on that.
Yeah.
Yeah, so we'll see. We hope that they get to a paperless file system at some point, and we also hope that they get to a place where we can easily transfer electronic documentation to them securely. We'll get there eventually. Hopefully it's not before we're retired. But when it comes to planning for your audit, we want to make sure that we place ourselves as a buffer between the client and the IRS agent. The taxpayers are always entitled to have representation. So we want to control the interviews that they're doing. If the agent is insisting on an interview, well, before we agree, we want to make sure that we know who the best person to answer the questions are going to be. If they think that it should be the business owner that should be able to answer all the questions, well, many times there's an employee or somebody who's handling the day-to-day operations regarding the issues that the IRS is auditing. Maybe they're a better person to respond to some interview questions, and that would limit the back and forth and try to get down to who can answer the questions in an efficient manner. And we always like to get a full view of the facts, what's going on with the taxpayer's business, what's going on with these issues that the IRS is interested in. Even if the agent hasn't asked specific questions about some things, we like to have as much information up front as we can. So we're not going to review every box here on this scope the examination slide, but we did want to talk a little bit about some of our IRS experience here. And Elise, maybe you can give us a quick overview on how you handled your exams when you were dealing with representatives. What were some of the easy to deal with situations and the not so easy to deal with? I know when I had CPAs or attorneys coming in to exam to meet with me, when they were well prepared, had all their documentation organized and laid out and tied out to the tax return, it just made things go a lot smoother.
Yeah, definitely. And I mean, you want to build a rapport with the agent, um, and like you said, be organized and provide documentation. I think one thing that it is good to note here is that it is important to have someone who's knowledgeable about the audit process in general, representing the client, because the IRS can take advantage of the overall process, including, you know, requesting information they may not be entitled to, or requiring lengthy interviews or that sort of thing, or just, you know, maybe not giving the taxpayer the necessary time to provide the documentation that they should be given. You know, they can just give you one shot and then issue a report. So it is important to have knowledge when going into the interview about taxpayer rights and the audit process in general. And we try and limit the scope of the examination to specific issues. So you can ask the agent in the beginning of the exam and be like, hey, what are your primary issues that you're going to be looking at? And they'll tell you, and you can basically see from the IDR what their, you know, primary issues are. For example, if they're asking for documentation for rent expense or for meals and entertainment, you know that that's a main issue. Like I said before, they're always going after income and losses, but other than that, the IRS agent isn't going to be looking at every line item on the return. That's just not.
Yeah, it would take too long.
It would take too long. It's not feasible, and they're trying to limit the scope as well. So,
Yeah, having a representative in the room can help. I'd hesitate to say stop the client from answering questions, but help them stay on topic. You don't
Right.
want to go into an IRS exam interview unrepresented and just start rambling on and on. Maybe you'd expose some issues that the agent hadn't even considered. You know, a lot of people think, well, if I can just get on the phone with the agent, or if I can just sit down with them, I'll just explain what's going on and this will all be wrapped up in one meeting. And typically that isn't my experience. You know, most IRS things don't get resolved in one meeting or one phone call. Sometimes if it's a complex issue to go into appeals, you know, it could be a year or longer process. So we'd hate to see someone get themselves into more IRS scrutiny than really they would be facing, just, you know, because they said a little too much in an interview.
Right, or maybe you provide too much documentation and expose yourself to an issue that the examiner didn't even know was present, and, you know, you provide you know, a full detailed description of something else they weren't looking into, and now all of a sudden it's an issue. So I mean, primarily they're looking to make sure that the taxpayer is substantially compliant.
Yep.
You know, with prior and subsequent years, they want to make sure they're up to speed, all returns are filed, and, you know, in general, there's no glaring issues that are, you know, blatantly abusive. But they also say that you could be audited multiple times and by different agents, and they'd all come up with different conclusions. So it isn't subjective. So
yeah, it's kind of it's not a perfect system, but we'll deal with it the best that we can. So some of the ways that we can do that are by these alternatives not considered by the exam agents. They have to apply the strict letter of the law, the tax code, and the regulations. But when we get into appeals and dealing with chief counsel, then we can sometimes use some substantial compliance arguments, say that, you know, there was no harm, no foul here. You know, they did basically everything but a couple steps. So let's see if we can reach a conclusion here that's acceptable to both sides. Or many times we'll use the Cohan rule from this Cohan v. Commissioner case that's been used in a lot of circumstances. We basically have some evidence in the record or in the file that will allow us to compute what a deductible expense would be then we can use this Cohan rule that the tax court has come up with and say, all right, we can get close enough here. This is how we can compute this amount even in the absence of contemporaneous documentation kept by the taxpayer. So if it's something that we can recalculate based on what's in the file, you know, an example might be we don't have the fuel expense records for a truck driver, but we do have his mileage logs that show where he was going and how many miles were driven. We could take that and combine it with the average price per gallon of gas for that tax year and sort of back into what the deductible amount would have been.
Yeah, I mean, the burden relies on the taxpayer to provide expense documentation, and the burden is on the IRS to prove income. Essentially, that's what they say. So, you know, they can't go in and just disallow a bunch of expenses if you don't have the documentation. They have to be reasonable, and that's one of the things that the Cohan is trying to protect. So obviously, a real estate agent is going to have mileage, or they're going to have meals and entertainment and stuff like that.
Right.
Whether or not it's, you know, to an extreme, or, you know, they've just deducted way too much, then they'll, you know, reduce it down. But obviously they are going to have some sort of expenses. Whether or not they have the receipts to back it up is the, you know, case.
Exactly. We want to make sure we get all your polling questions in for your CPE credits. So let's move on to this polling question, number 3. And it's: a taxpayer must sign a statute extension when a revenue agent requests one in order to get the case to IRS appeals. Is that true or false? And we'll get that polling question popped up. And while you're answering that, we'll just start going on to some additional information here on IRS penalties. So before we get to penalty abatement issues, let's talk quickly about how we get a case to IRS appeals. There's a few different ways. The two primary ways are what we refer to as 30-day appeals or docketed appeals. Docketed appeals is the same as 90-day appeals. So if you get a 30-day letter from the IRS agent saying you have 30 days to respond, then we can file a protest letter and get the case directly to appeals that way. If we don't respond to that within 30 days, then the IRS will issue a statutory notice of deficiency, which gives the taxpayer 90 days to file a petition in United States Tax Court to preserve their appeal rights. Once that's done, then the case does go to IRS appeals. We like to think that we have more control over the appeal process if we go the docketed appeals route after a notice of deficiency is issued. It also gets the case considered by appeals faster than just going to 30-day appeals, because there's that chance that the case will get set for trial in tax court. So the appeals officers work those cases a little faster. But the Office of Chief Counsel Attorneys, they're tasked with finding the right tax. Whether that means they're going to work with us towards a reasonable settlement quickly or not is all dependent, of course, on the actual attorney who's assigned. But if we can't get the case settled with appeals, then we can go to an Office of Chief Counsel Attorney and work with them to either substantiate the issues or come to an agreement on the legal issues in the case. Very few cases actually go to trial in tax court. Tens of thousands are petitioned every year, probably about 30,000, I think. A small number actually go to trial, but I'd say 80% or higher nationwide, the cases that are petitioned in tax court end up getting settled in appeals or by a chief counsel attorney prior to going to trial.
Okay, so penalty abatements. We get a lot of penalty abatements coming in every day for basically every type of penalty possible. First time penalty abatement is a big one. A lot of people don't even know that this could be an option, but essentially, if you have been compliant in the past and you've never had an issue with penalties before, then this type of abatement should be available to you. It's for individuals or businesses who have had, like I said, a history of compliance. If the taxpayer exercised ordinary business or care, that's a reasonable cause. But we always try first time abatement first. and we'll double check and see if they've ever had this applied before. And if they haven't, we'll go ahead and request that. You can call, or you can send in a letter to get that abatement applied. Moving on, a couple of statistics here regarding penalty abatements. As you can see, the assessed amount of penalties and the abated amount is not that large, but if you actually look into the percentages of the dollar amount abated, it's actually a decent amount. So we will always try and get those penalties abated, and if it doesn't go through the first time, we will definitely always appeal those penalties as well. And throughout an examination, if you do get an accuracy penalty applied, you can oftentimes go to the manager and try and work with them before the case goes to appeals and try and get that abated through them as well.
So here's a pretty new issue that the IRS and the State Department are doing. It has to do with passport revocations and denials. So if a taxpayer owes more than $51,000 in back taxes, penalties, and interest, then the Treasury Department is going to certify them on the list to the State Department, and that individual will not be able to renew their passport. I don't know if they're proactively revoking anyone's passports, but if you send in a renewal request, then it's going to be denied until you get the tax balance below $51,000. There are some circumstances, though, that this won't apply. If you're in an installment agreement, making monthly payments, if you have you're working with the taxpayer advocate to try to get this resolved, then the IRS and the State Department are not supposed to certify you on the list. So if you or any of your clients are dealing with any issues with passports and balances due, we can try to help out and get that resolved. Some new developments on the partnership audit rules. The prior regime was the TEFRA rules, but the Bipartisan Business Act that went into effect has changed the landscape dramatically for audits of partnerships. So there's some new rules here. The IRS can assess the tax at the partnership level rather than the partners. It can make it easier for the IRS to audit and go after some very large partnerships. There's no longer the same representative as before. Now anyone can, it used to be the tax matters partner. Now there's a partnership representative, which can be anyone, doesn't have to be a partner of the partnership. Partnerships can elect out of these rules under certain circumstances, and the adjustments can also be pushed out from the partnership to the partners. So there's some various different ways that the partnerships can be audited now. And a lot of this is also up in the air because it was effective for 2018. Some of those returns have been filed, some are still on extension to be filed, and the IRS hasn't really started examining any 2018 returns at this point. So we'll see how all of this plays out. But if you want to elect out of the new partnership audit rules, that election has to be made every year on the timely filed tax return. And that gets you to the pre-TEFRA landscape. TEFRA is not in the mix anymore for partnership audits for partnerships going forward. If you don't elect out, then your partnership gets audited by the IRS, and the IRS proposes some adjustments at the partnership level. At that point, the partnership can pay the tax, or it can make an election to push out the adjustments to the partners themselves. But also the adjustments are going to be made in the current year rather than the year under exam for these new partnership audits. So it's adding a lot of complexity to partnership audits, some new choices that need to be made in terms of designating a partnership representative, making the decision on whether to elect out or not. Do the partnership agreements need to be modified or amended to reflect who's going to be responsible for the tax in the instance that a year comes under audit, but the partners are different now than the partners that under that year. Our National Tax Office experts, Adam Sweet and Todd Laney, are the gurus in this area. If you have additional questions on these areas, then they would be a great resource we can put you in touch with. Obviously, the corporate tax rate has been lowered as part of tax reform, and they created this new Section 199A deduction for pass-through entities. It basically provides a 20% deduction from qualified business income, or QBI, for a lot of returns. So 1065 flow-through partners. If you're on a Schedule C business, you're also eligible, but there's a lot of limits on what businesses qualify and what is the amount that gets into making up qualified business income. There's also a list of specified service trades or businesses, SSTBs, that don't qualify for the Section 199A deduction. Although the caveat there is that even a specified service trade or business can qualify for the deduction up to the income limits, which is $315,000 for a married filing joint taxpayer. But the limit on the 199A deduction is 50% of W-2 wages included in the trade or business of the taxpayers, or the sum of 25% of the W-2 wages and 2.5% of their unadjusted basis in qualified property. So it's going to depend year by year what trades or businesses the individual is involved in to determine their 199A deduction. You'll have to gather all the information about all the businesses that they're participating in. So again, if you're a specified service trade or business, attorneys, accountants, a lot of service businesses, you can still get the deduction up to the income limit, and then after that, no. But let's talk a little bit about what the effect of some of these tax reform changes are going to be to the IRS. So how are these new tax laws affecting the IRS? Obviously, these are some pretty big changes to the tax code, partnership audit rules, new deductions, some deductions disallowed through 2025 on the individual side. It's going to take some significant work at the IRS to figure out what do these new laws mean. None of these changes have been tested in an exam, in appeals, in tax court litigation. So it all remains to be seen what some of these new things mean.
And, while they'll be having education on these topics and, learning about them, they're not actually going to experience the issues with having audits for a couple of years since they're behind. So they'll kind of be learning as they go as well. So it's going to be a big mess at the IRS for a while.
I think so, yeah. And before you left the IRS and joined us about 6 weeks ago, Elise, had you really had much of any training in these new areas, or were they leaving that to the future when they, closer to when they started auditing those returns?
Yeah, they provide training, they provide classes, online webinars and CPE and that sort of thing. But like I said, no real experience yet has come out of it since it's all, in the coming years. So
yeah, it all remains to be seen. We'll see what happens. I'm going to skip past a couple of examples that you can refer back to afterwards and talk about who does some of this tax reform changes benefit and who does it not help. Obviously, rental real estate businesses benefit based on the way the tax reform bills were written. Engineers and architects are benefiting because they were originally on the list of personal services businesses that would be excluded from the 199A deduction, but then were removed from the list. And who does it hurt? Obviously, personal service businesses, those specified service trades and businesses that are capped on the 199A deduction at the income limit, they are not helped out here by any of this. Some big changes to individual income taxes, obviously the big increase in standard deduction, but the elimination of personal exemptions made a big change, elimination or reduction of some itemized deductions through 2025, and then increased child tax credit and the new individual credit. Those items are, helpful for some, not so helpful for others. It all depends on the individual's circumstances. And the estate tax exemption or exclusion was increased quite a bit, up to 10 million, and also indexed for inflation. So we'll see what happens when some of these provisions start to sunset on both the individual income tax adjustments and estate tax. Once, will the bill exist in its current form when it's scheduled to sunset in 2025? It remains to be seen. Obviously, we all thought that there was no way that we would get to the point where the estate tax was repealed, and then it ended up happening for a year. Obviously the tax reform bill in 1986, that was around for about 30 years, but at the end of that life, did it really resemble what it looked like when it was originally written? So the tax laws are constantly changing, evolving. IRS guidance comes out, Treasury regulations are released, and it all remains to be seen how the IRS applies some of these rules in audit, on appeals, and in litigation. Yeah, thanks everyone for attending today. We'll pop up our contact information here at the end. If you have any questions or issues, you can contact us directly, or you can contact anyone on the tax controversy team, whether that's Ben, Peeler, myself, Elise, or any of our other tax controversy team members. And if you have any other issues that someone else in our National Tax Office may be better to assist with, we'd be happy to put you in contact with one of them.
Yep, thank you guys.
Well, thank you for everyone for attending, and have a great day.